So we've looked at how to price a bond. We've looked at issuing a bond at face. We've looked at issuing a bond at a discount. Now let's look at what happens when we issue a bond at a premium. So Parker Company issues 750,000 12% 5-year bonds on June 30th, 2013. Again, these are older examples, but it's still applicable today. The bonds pay interest semi-annually on June 30th and December 31st. At the time of issuance, the effective rate of the bonds was 10%. So notice our market rate of 10%, also known as the effective rate, is lower than our actual stated rate on our bond at 12%. And when that occurs, we issue the bond at a premium. We get to charge more, or we get to charge over face value, I guess is the best way to say that, for this bond. All right, so let's talk about our face value here. We know our face value is 750, that's what's on the bond. We know the stated percentage rate is 12%, and we know the effective or market rate is 10%. Now the term is in years. This is a 5-year bond, and it pays semi-annually. Now, to find the issue price, we did this in video 2, actually, or lecture 2, the bond pricing. It was the last example down there. So in that, we got 807,911 in the video. So that should be our bond pricing. Again, if you need to review how to calculate bond price, go back to lecture 2, the bond pricing. For this bond, it's the last example in that video, so it's toward the end of the video. Now notice, since the issue price is more than face value, this bond is issued at a premium, which is what we expected because our stated rate of 12% is greater than the effective rate. Or another way to say that, the effective rate is less than the stated rate. All right. Now, there are 2 methods in which we can amortize this bond. In other words, find out the interest expense. One is the effective interest method. So that's the first method we'll use, and then we'll look at what it would be if we did the straight line method. Now, when you downloaded this from Blackboard, it may have messed up the formatting a little bit. I've tried to load it a couple times and it still gets a little off. So if you need to fix exactly where your grids are, that's fine. But let's start with the effective interest method. Now, on the first line of the effective interest, this is actually the beginning point. This is when we issue the bond, which would be 1/1/13, I believe it was. We issued it on January 1st. We did. So I'm going to split my screen here just so we can get the information on board. Now, in this case, everything's going to sort of be blank here. Fill in these cells here. Well, if I can hit the right button, it would help. Hold on. There we go. All right, so nothing will go in the first line except your initial carry value. And the initial carry value on a bond is the issue price of the bond. So in this case, it's going to be the 807,911, excuse me. All right. Now, remember, when we talk about a bond, it's a 5-year bond, so we're not going to do 10 listed payments, but the carry value has to work its way down to face value. So we're starting at 807,911. We're going to work our way to 750,000, the amount we have to pay back at the end of the bond. All right, now to find the interest payment, remember the interest payment formula, we're going to take the face value of the bond times the stated rate of the bond times time. This will be very consistent with every single payment. We have to pay out the same amount every 6 months. So let's really quickly do that. I'm going to go back up here. And since we know our stated rate, to find my interest payment, the actual amount of cash I have to pay out, we're going to take 750,000 times the stated rate. Why not put ST? That should be SR, excuse me. Times the stated rate of 12% times the time period. Well, this bond pays semi-annually. So that means they're going to pay every 6 months on June 30th and December 31st. So we're going to multiply that by 6/12. All right. So take just a moment, come up with your interest and see what you got. All right, hopefully you paused the video and did that. So we take the 750 times the 12% times the 6/12, and we end up with 45,000, which is the same amount we again had in video 2 there, lecture 2. All right, so that's the amount of cash we will pay out every 6 months. Now, hint, that number does not change. It's going to be the same every single time we have to pay interest. So we're going to go in and hit 45,000 for all those payments. Now, interest expense. There's two methods. Under the effective interest method, again, we've already talked about this a little bit, but let's review. We take the carry value of the bond. I can't hit the right keys for nothing. Multiply that by the effective rate, the market rate of the bond at the time of issuance, and then multiply that again by the time period. Okay. All right. So again, for this one, let's go back up here to find the interest expense. Now, interest expense will change each time. In this one, we're going to take the 807,911, multiply that by the 10% times 612. So again, pause the video just a moment and see what you come up with. All right, so we're going to take the 807, you should have taken the 807,911 times the 10% times 6 divided by 12, and that would give you 40,395.55. Let me fix this. Double check my math. So 807,911 times if I can find the right keys, times 10% times 6 over 12 or half. So basically it's 5%. I get 40,395.55. We're going to round, so 40,396. Keep it simple. Now, does it make sense that our interest expense is less than the amount we pay out? Well, absolutely, because think about it this way. The bond is paying 12%, but it is only priced to yield 10%. So therefore, your interest expense at 10% should be less than your 12% payout. All right, so that brings us the amount of amortization here. So we're going to take the 45,000 minus the 40,396, and we're going to get amortization of 4,604. Then that brings us to our unamortized balance, or the balance in the premium account. And now, if you want to, you can go ahead and add that back up here. So let's just fix this cell. If it helps you, go in. What did our premium start at, or our discount start at? Well, we would take the premium is the difference between the issue price, the 807,911, and the face value, the 750. So our amortization started at 57,911. Now, amortization, this column will always work its way to 0. So at the end of the day, this should be, well, let's just say works down to 0. Okay. So every time we amortize, we're going to reduce the balance in the premium or discount. So we're going to take the 57,911 and subtract the 46,04, and that leaves us a balance of 53,307. Now, what's our new carry value? Well, the carry value is working its way up to face value. So if it helps you, what I like to do is go down to below, underneath. Well, I had a little freeze up. I am working my way to 750. In other words, if I did all 5 years of interest payments, 10 payments, I'm not going to, but if I did, at the end of the day, my carry value of this bond should equal the face value of 750. This helps me to realize which direction I need to go, because in a premium, we work our way down to face, but in a discount, we work our way up to face. Okay, so I start at 807, I need to be at 850. That tells me I need to subtract. So I'm going to take the 807 and I'm going to subtract the 4604. So 807,911 minus 4604, 803,307. The other way to look at it is the carry value is the bond account, the bond payable of 750 netted with the premium account. And since the premium account has 53 in it, you could take 750,000 plus 53,307, and that would also give you the 803,307. So you can calculate it a couple of different ways there. All right, now let's do our interest for the next period. We have to be careful. Under the effective interest method, it's going to change each time. So now in this case, we need to take not the 807,911, but we need to take the new carry value of 803,307 and multiply out by the 10% times 612. So we take 803,307 times 10% times 6 over 12, and that gives me 40,165.35. Again, we're going to round to the whole dollar, so proper rules of rounding would be 40,165. Just keep it easy. Let's not worry about pennies right now. So we're going to take 45,000 minus the 40,165. We get 4,835. That brings our amortization. Again, this is working its way to zero, so take the 53,307 minus the 4835, and that's going to give you 48,472. And that's going to give us a new carry value. So we're going to take the 803 minus the 4835. And we get 798,472. Okay, so that's one way. Or you can take the 750 plus, because the premium would take our face value up, or take our carry value up, excuse me. 48,472 plus the 750 would give you the same result. So either way you want to calculate it is perfectly fine. Just be careful and make sure you don't mess that up. Okay? And again, we're working our way down to face. So eventually this will be 750,000 if we were to do all 5 years. All right, so pause the video here and take just a moment and finish up the rest of the chart, because I think you can do it on your own. And then we'll come back and we'll have the solutions in there. Hopefully you paused the video and worked through the rest of the chart, but here it is. There is our the rest of the chart that we've done. Now remember again, why does this not equal 750? Because we're not doing all 5 years. We're only doing actually 2 years, only 4 interest payments. So therefore we got quite a ways to go to be fully amortized, but note it keeps declining over time, so eventually it will get to that 750. All right, so that's the straight line, or excuse me, the effective interest method for calculating the interest expense on a bond. Now let's journalize this bond at least a little bit. Now we're not going to do all the journal entries here. Let's just do the first couple and let's see, what does it ask us for? Doesn't really say. So let's just do the inception of the bond, the creation of the bond, and then a couple of interest payments here. So once we have the bond amortization chart, it's very easy to do the actual entries. So let's split our screen. So we're going to go in, and on January 1st of 13, we're going to go and we'll hit our cash account, because when we issue the bonds, we're going to receive the issue price of 807,911. Then we're going to hit, now I always skip a line for the discount of the premium. That way it's always there. And I know we need to hit bonds payable. Remember, the bond payable is always going to be carried at its face value as far as the account goes. Now on the balance sheet, it's carried at its carry value. But in the actual bonds payable account, we're going to hit it's carried at face. And then do I need a premium or a discount? Well, in this case, I need a premium because I received more. So our premium on bonds payable will go in, and that would be the 57,911. And that way we know we're in balance. So that would be our inception when we actually issue the bond. Now let's go and talk about what happens when we pay our interest. Well, the cool thing is once you have an amortization chart, this gives you your entries. So if you look at these first 3 columns, that's pretty much all you're going to hit. Interest expense is always a debit. So I'm going to go in here and just say, hey, this is a debit account. We're paying out the interest, so this would be a credit to our cash because that's the amount of payment or amount we're paying out the door. And then whatever we need to plug in actually equals our premium or discount. So the amortization amount, depending on if it's a discount or a premium, will flip-flop. So let's just do what we know for a fact. We know we need to debit interest expense. And we're going to debit that account for $40,396. That's the amount of interest expense on this first interest payment. We know we need to go in and we need to credit cash because we're making the interest payment of $45,000. Now, remember, what happens to the premium as we go through? Well, the premium is reduced. Well, what did you do at the beginning? You credited the premium for $57,000. As you get rid of it, how would you amortize a credit balance? We have to debit the account. So hopefully, once we go in here, do I need a debit to my premium on bonds payable? Yes, because that's what's going to balance my entry. So that's awesome that we know we're sort of comfortable. We know if the premium goes in as a credit, to amortize it, we have to debit it. So it gives you a little bit of comfort that at least you're going in the right direction for your premium. All right, one more. Let's do the December 31st entry here. Again, we're still in this first 2013 year. So what would we do? Well, just like before, we're going to hit interest expense. That's our debit account. We're going to hit it for the $40,165 this time because the amount shown. And we know we need to credit our cash for the $45,000, the amount of cash we're spending for the bond. Now, where does the difference go? Well, again, remember this is a premium, so we should hopefully need a debit. So we're going to go in and debit premium on bonds payable. And we should need a credit for, in this case, $4,835, which balances the entry. Now we could continue on. Keep in mind the entry would be exactly the same every 6 months. The only thing that would change would be the split between the expense and the amortization. The expense will constantly go down with a premium bond, and the amortization will go up to where this count eventually equals 0, and this column will eventually equal 750 if you were to do all 10 interest payments or 5 years. Now let's look at this exact same problem, but let's do the straight line method. So again, we're going to, let me hide these cells because you don't want to put anything in them for sure. So January 1st of 13, where do we start? Well, if you want to go ahead and put your balance in, you can. And then 807,911. It's the same starting point whether you do the effective interest method or you do the straight line method. Okay? Fix my formatting just a little bit so we can see. Oh, that's not working. Okay, drag this up in. Sometimes me and Word does not get along very well. All right. Now, the other thing that's going to remain consistent is the cash that we pay out. No matter whether this bond's issued at a premium or discount, the cash amount paid out every 6 months is going to be the same. It's calculated with that face value times the stated rate on the bond times time. So this is exactly the same under the straight line method. FV times SR times T. Now, what's the difference? Well, the interest expense in the straight line method is a plug. Okay? What we do is we figure out the amortization first. So what we're going to do is we're going to take the total premium in this case. If it's a discount, you would just take the discount. And you're going to divide that by the number of payments. I know it keeps shifting me down, but that's okay. So what does that mean? Well, for this bond, we're going to take $57,911, the total amount of the premium, and we're going to divide that by 10 payments because it's a 5-year bond. Pays out semi-annually. Let me double check that information. I haven't forgotten anything. Yes, it's a 5-year bond, and it pays semi-annually. So that means there's going to be 10 interest payments over the life of this bond. So take a moment. See what that gives us. 57,911 divided by 10. We should be able to do this in our head, but if not, let's get our calculators out. Gives us 5,791. Again, we're going to round. It will not work out perfect, I understand that, but let's round to the whole dollar just to keep it simple. All right, so we know our amortization is going to be 57,911. Now, we need to back into our interest expense. So this is where it gets tricky because it's different whether it's a premium or a discount. Okay, so think of it this way. Our stated rate on our bond was 12%. Our interest expense is, our interest effective rate, excuse me, is 10%. So with that information, should our interest expense be lower or higher? Well, since my rate's less than, I need to subtract. If we flip this and say 14%, we would need to add because we would need to go from 12 to 14. We would have to add to our interest. In this case, though, we're going from 12 to 10. We need to subtract from our interest. So 45, we're going to subtract the 57. So 45,000 minus the 5791 gives me 39,209. And again, it's the 45,000 minus the 5791. For a premium, you're going to subtract those two. If this were a discount, you would need to add them because the rates would be higher. Okay? So be really careful with that when we go in. Now, what's our unamortized? Let me fix the formatting here. Unamortized balance would be, again, this is working its way to 0. So if we were to go down here below the chart altogether, we know that this one eventually has to be 0, and just like before, this needs to be 750. Okay? So how do we get to 0? Well, we reduce. So we're going to take 57,911, and we're going to subtract 5791 from it. And that's going to give us 52,120. And that's going to leave us with 802,120, which is 807,911 minus the 5791, or the 750 plus the 52,120. Either way. Now, the cool thing about straight line, once you calculate it once, if you do it right, it's going to be the same amount each time. Hence the word straight line. It's equal over the interest payments. Now, we are allowed to use straight line if the results are not materially different from the effective interest. So really, the effective interest method is the gap method. It's the preferred method because it more accurately reflects the time of money there. But when we get into the straight line method, if it does not create a difference that's material between the two, then you could probably use it. You would be okay. Keep in mind, most bond issuances aren't really $750,000. That's a very low amount. So if you're talking about millions of dollars and you have, a few $1 million discount and you divide that over 10, you could have a much higher difference between the two. So we want to be careful with that. So the effective interest is the preferred method. The straight line can be used if the results are not materially different. All right, so let's finish out this 52,120 minus the 5791. Let me just finish each of these. 46,329 minus the 5791. 40,538 minus again the 5791, and we get 34,747. Now again, you can take the 802 minus the 5791 or the 750,000 plus the 46. So in that, we get 802, 120 minus the 5791 gives me 796, 329. Well, I could just add and we'd be okay. So 790, 538, and 784, 747. So that's sort of our answers there. All right. Any questions on the straight line, let me know. But that's basically it. Now, what's our entries going to be like on the straight line? Well, they're going to really be the exact same entries. So I'm going to, cheat just a little bit? The entries are the same for the bond regardless. So from a debit credit standpoint, we're going to do the same basic journal entries this time as we did before. We still receive the same amount of cash upon issuance, so our issuance entry will be identical to the last. The 807,911 is the issue price. That's the amount of cash we would get. Again, we're ignoring issue costs in these problems. The premium is the difference between issue price and face, and then the bond is carried or recorded at the face value, the 750. Now here we would have a little bit of difference because notice our amortization is going to be different. So let's split our screen again. Under the straight line, our interest expense this time would be $39,209. Our bond premium amortization would be $57.91, and then our cash should be $45. And this is a great place to check to make sure that you did this interest expense column correctly. Remember, it flip-flops between the two, whether it's a premium or a discount. This column is flip-flopped. Always check. Notice the premium was credited on day one. If you accidentally did this backwards, you would need a credit here, and that would make the premium go up. So make sure when you pay your interest, you're always doing the opposite on the premium or the discount. If you credit at the beginning, when you journalize the interest, you better be debiting. If you were to debit the discount at the beginning, you better credit the discount as you amortize. So keep that in mind. It sort of is a way to sort of get in your mind the direction. And that way, if you accidentally mess up on a calculation, it should sort of show, whoa, wait a minute, I know I'm wrong because I credit here, I have to debit here. If not, we've got an issue. Okay, that's working its way to zero. You've got to have a debit there. All right, now guess what the entry is going to be next time? It'll be exactly the same because it's straight line depreciation. All right, so hopefully this helps you understand a little bit more about how to record a bond that was issued at a premium, just a basic bond issued at a premium, both the effective interest method and the straight line method. I hope everyone has a wonderful day.